Great to have you. That's my question. How is an investor supposed to balance all of this? Where do you think is the right way to look? Should I be looking at oil in Iran, or should I be looking at earnings?
Yeah, it's a critical question, because I think when we're at moments like this where you really have a trifecta of concerns, you have the war, you have private credit, and then to your point, you have this AI disruption theme that's wreaking havoc over the software space. I think the temptation is to focus on the headlines, but the reality is that not every headline translates directly to earnings. And in fact, we're in the midst of a very strong earnings season, and we have these pockets of valuation opportunity. So I would argue that, yeah, we want to monitor what the ultimate impact is of a lot of these variables on the underlying fundamentals, but there's a reason to think that the fundamentals won't necessarily collapse, and there are these pockets of opportunity to take advantage of.
Let's talk about the fundamentals. Coming into this week, the limited earnings that we'd had so far showed that earnings growth was up 30% year over year. Is this a strong earnings season and also top-line revenue?
It looks to be thus far. I mean, to your point, we're very early in the earnings season, but we are seeing strong revenue growth that's outpacing expectations. And I think that's a very important signal, because it speaks to the aggregate demand in the economy, both for the consumer and for the enterprise. So we have a long ways to go. There's going to be some key tests in the coming weeks, but I think we can at least take these early signals, including the signals from the banks that are suggesting that consumers remain in reasonable shape. I think we can take those signals and have a certain level of optimism around them.
Underneath the surface, I'm wondering if there is becoming a very clear divergence between hardware and software. We talked in your introduction about the SaaSpocalypse. Those fears are coming up again, but the the SOX index, that Philly Semiconductor Index, looks like it could be 16 or 17 straight days of gains. That is a record for this index since it was created 32 years ago. So hardware, TSMC, ASML, those look really strong. What do you make of that divergence?
Well, it's interesting because, of course, all of these roads are leading back to AI, but it's from different directions. So when we're looking at hardware, of course, that's the supply side, that's the infrastructure build of AI, and the demand there just seems insatiable. We'll get another look at that as we see what these CapEx numbers look like next week. But there does seem to be this insatiable build to build out AI, and those names, those hardware names, are benefiting from it. On the other side, we have the SaaSopolis, if I can say that correctly, where we're seeing these businesses just getting disrupted, and questions around what their business models look like when we start to have a competitive threat from AI. Now, the interesting thing is I would actually argue that some of those software names are where the opportunity lies, because the price movement has been so severe, but potentially these businesses won't all be disrupted to the same degree. So there could be some of those opportunities emerging there, but it's for the long-term investor. You won't get instant gratification on this one.
I want to talk about long-term investors. One is the U.S. government. They had a 20-year bond auction this week that seemed to actually go okay. If bonds maintain their well-behaved nature, I'll call it, with a 10-year at a 4.32, can equities go higher as long as bond yields don't spike?
Well, when we think about how bond yields behave, we have to think about the inflation side of things and the growth side of things. So if we start to anticipate better growth expectations, then that's a place where we could see stocks do well, regardless of what's happening to yields. But if we start to see bigger inflation concerns than the market is currently pricing in, I think that can be short-term pressure for the stock market and, of course, pressure for the bond market. And, of course, that's what we saw over the course of March, was that pressure in the bond market. So that remains to be seen. I think we're seeing this develop in real time, and some of the effects of these oil prices are down the road in a few months' time.
We will have you back in a few months to see how these developments pan out. Marta Norton, thank you so much. Pleasure.
My pleasure.